Hey everyone, welcome back to Corporate Dakota. Today we're diving into Travel Class Leisure Co.'s latest quarterly report. They've given us a peek behind the curtain, and judging by the numbers, it looks like they're navigating a tricky economic landscape with some interesting wins and challenges. So buckle up as we decode what this all means for the company and its future. Make sure you're subscribed because we break down these filings so you don't have to. Also, join our Discord community linked in the description below. It's the best place to connect and discuss these insights. Let's start with their income statement for the 3 months ending June 30th, 2025. They brought in a total of $1,018 million in net revenues, which is up from $985 million in the same period last year. That's a solid increase, showing they're still growing despite tough economic times. A big part of that growth comes from their vacation ownership interest sales, which jumped to $474 million from $441 million. This suggests people are still buying into the vacation ownership dream. Their consumer financing also saw a slight bump, bringing in $112 million compared to $111 million last year. This might indicate that more people are taking out loans to buy vacation properties. Now, expenses did creep up to $812 million from $700 and a huge jump. But it's something to keep an eye on as they spend more on operating, marketing, and general administrative costs. Despite the rise in expenses, their operating income actually went up to $2,006 million from $189 million, which is great news. It means they're managing their costs effectively enough to turn that revenue growth directly into profit. And the bottom line, net income attributable to Travel Leisure Co. shareholders came in at $108 million. That's a bit lower than the $129 million reported for the same period last year. This drop is mainly because last year they had a $32 million gain from selling off a discontinued business. Without that one-time boost, their core operations are actually doing better this year. Looking at the first half of the year, things are also looking up in terms of revenue. Total revenues hit $1.90 billion last year, but again, the net income attributable to shareholders is down from $95 million to $185 million to $185 million to $81 million, again, largely due to that discontinued business sale in the prior year. Digging into the vacation ownership side, gross VO sales are up 7.8% year over year, reaching $654 million. This is good, but their provision for loan losses also increased significantly from $130 million to $138 million to $28 million to $28 million. This basically means they're setting aside more money for potential bad loans, which could indicate more people are struggling to pay back the loans for vacation properties. The number of tours, which is how they show properties to potential buyers, also went up slightly to 19,700 from 19,200. And importantly, their volume per guest, or VPG, which measures how much each person spends per tour, increased by 6.5% to 351 buyers. This is a really positive sign. They say this is due to more buyers being existing owners who are upgrading their vacation ownership deals. These upgrades usually mean more money spent per customer. In their travel and membership segment, however, the picture is a bit different. There are exchange transactions where people swap their vacation ownership time, dropped by 10.8%. This is likely because more members are part of affiliated clubs and don't need to swap as much. Travel club transactions, on the other hand, have increased by 7.2%, showing some growth in that area. But overall revenue per transaction for this segment dropped by 4.6%. So while they're doing more travel club deals, those deals are bringing in less money on average. And the number of exchange members dipped by 3.5%. This suggests a shrinking customer base for their core exchange business. Looking at their balance sheet as of June 30th, 2025, total assets stand at $6.8 billion, a slight increase from $6.7 billion at the end of last year. Their cash and cash equivalents are up to $212 million from $167 million. That's a healthy increase, showing they have more readily available cash. However, their vacation ownership contract receivables, which are basically loans they've given out, are still high at $2.5 billion. Even though it's down slightly from last year, it's a huge chunk of their assets, and the health of these loans is crucial. Their overall debt is also significant, standing at $3.6 billion. It increased from $3.4 billion at the end of last year, mainly due to new borrowings on their revolving credit facility. with total liabilities at a hefty $7.6 billion and total deficit at $853 million. It's clear they're carrying a lot of debt. Now let's talk about cash flow. For the first 6 months of the year, they generated $353 million from operating activities, a big jump from $221 million last year. This is largely driven by better collections on those vacation ownership loans and less cash tied up in working capital. Financially, they bought back 2.8 million shares for $140 million in the first half of the year. This is part of their ongoing share repurchase program, which is a way they return money to shareholders. Looking at the segment performance for the first 6 months, vacation ownership saw a solid revenue increase of $76 million, and their adjusted EBITDA, a measure of operating profit before certain items, jumped $38 million. This shows their core vacation ownership business is doing quite well. However, the travel and membership segment saw revenues drop by $25 million and adjusted EBITDA decrease by $14 million. This segment is clearly facing headwinds, likely due to the shrinking exchange member base and lower revenue per transaction we talked about earlier. Their corporate and other segment, essentially the overhead and company-wide costs, showed a decrease in adjusted EBITDA, meaning those central costs went up by about $7 million. So to sum up the financial condition, total assets increased by $74 million, largely thanks to a healthy rise in cash and an increase in inventory, likely to support future sales. Liabilities also edged up by $47 million, mainly due to more debt. Yet the total deficit actually decreased by $27 million. Primarily because of the strong net income from operations and positive foreign currency adjustments, even though they also spent a significant amount on stock buybacks and dividends. Now, regarding liquidity, they seem confident. They're managing their cash flow well, have access to credit lines, and believe they have enough funds to cover upcoming debt payments and business needs. They even managed to secure new financing deals with favorable terms, showing resilience even with market volatility. When I look at this, Travel Clear's Leisure Carpu seems to be doing a good job of growing its core vacation ownership business. It's really the engine driving their revenue and profits upwards. The increase in volume per guest, especially from existing owners upgrading, signals a strong product offering that holds its value even in tougher economic times. It's like they've got a loyal customer base that keeps coming back for more. However, the travel and membership segment is definitely a weak spot. The declining number of exchange members and lower revenue per transaction are concerning. It looks like this part of their business is struggling to keep up with industry changes and competition. They're seeing some growth in their travel club business, but it's not enough to offset the struggles in their main exchange operations. Their debt levels are something to watch. While they've managed it well so far, a significant amount of debt combined with a challenging economic environment always carries risk. The increase in their loan loss provision also suggests they're preparing for the possibility that some customers might not be able to pay back their vacation ownership loans, which is a direct reflection of broader economic pressures. Overall, Travel Clear Leisure Carpu is a company with two very different stories playing out. One is a story of steady growth and strong execution in their vacation ownership business, and the other is a story of adaptation and potential struggle in their travel and membership segment. Their ability to continue growing the vacation ownership side while finding a way to turn around or strategically manage the travel and membership segment. Their ability to continue growing the vacation ownership side while finding a way to turn around or strategically manage the travel and membership segment. Their ability to continue growing the vacation ownership side while finding a way to turn around or strategically manage the travel and membership segment. Their ability to continue growing the vacation ownership side while finding a way to turn around or strategically manage the travel and membership segment. Their ability to continue growing the vacation ownership side while finding a way to turn around or strategically manage the travel and membership segment. Their ability to continue growing the vacation ownership side while finding a way to turn around or strategically manage the travel and membership segment will be key to their future success. What do you think about these results and Travel Leisure Co. Sia at Vacation? Don't forget to join our Discord. The link is in the description. Thanks for watching, and we'll see you in the next one. And